Our first panelist is Nick Retsinas. He is a true expert, maybe the expert, in housing financial markets. He's the director of Harvard University's Joint Center for Housing Studies. He teaches housing studies at the Design School, at the Kennedy School, and teaches real estate here at the Harvard Business School on this faculty. Prior to his Harvard appointment, Nick was the Assistant Secretary for Housing in the Department of Housing and Urban Development in the Cabinet. He served on the board of the FDIC. He was the director of the Office of Thrift Supervision. He has been on the board of Freddie Mac, the Community Development Trust, the Center for Responsible Lending, and is the immediate past chair of Habitat for Humanity. He's been teaching about and writing about housing financial markets for a very long time. Nick.
Thank you, Jay, and good afternoon to each and every one of you. What I want to do just for a couple of minutes is talk a little bit about where we were, where we are, how we got there, and maybe between us we can figure out where we might go from here. The roots of the modern housing finance system in the United States began in the New Deal, when a number of programs were put into place to address the Depression, or as we in the housing sector like to say, the first Great Depression. And it was trying to figure out how best you could make credit and liquidity available to people buying a home. Before the Depression, if you wanted to buy a home, it required a 50% down payment. That's 5-0. A 5-year interest-only note, and you'd cross your fingers you could refinance it at the end of 5 years. Clearly, not many people own homes. Not many people could borrow under those terms. Under the New Deal, a number of programs were enacted that exist today and in many ways undergird today's housing finance system. The Federal Deposit Insurance Corporation, ensuring that deposits stayed in bank, the Federal Housing Administration, which helped lead to long-term mortgages, and the National Mortgage Association, which eventually evolved into Fannie Mae. And that was the system in the 30s, and it started to reopen credit lines to people to buy homes. And it pretty much evolved fairly slowly in a pretty sort of straight line, with some cycles, of course, into the 1980s. In the 1980s, the traditional loan was made by a regulated bank, a deposit-taking institution. They most often kept the loan on their books, retaining the credit risk, but over time they would sell more and more loans to the secondary market, particularly the Fannie Mae and Freddie Mac that had evolved since then, in order to relieve themselves of some of the interest rate risks. So that's the way the world was in the 1980s. In the 1990s, a couple of things happened that really set the stage for where we are today. All of a sudden, there emerged automated underwriting. There emerged credit scoring. And all of a sudden, the world of deposit-taking institutions, your neighborhood bank, all of a sudden transformed into these large national mortgage banks. A mortgage delivery system that was populated by brokers, by mortgage banks, and by investors. It opened the door to new sources of capital from around the world. Holding that door wide open were Fannie Mae and Freddie Mac. By that time, those government corporations had become private corporations, but still overseen by the government. It's interesting as one looks back to that period of time, one of the arguments for moving down that path was not only opening the door to more liquidity, but also, which is going to sound very, very strange, it's less risky if we do it that way. That somehow if we don't keep all the risk with these banks, but we find a way, as Jay said, to slice it and dice it, parcel it on, who better than investors to better assess, better price, and better absorb that risk? That was the argument, an ironic argument, as we have learned. Well, all of a sudden, that helped fuel a housing boom in the 1990s. You couple that with strong demographics, people coming to this country, needing a place to live. You add low interest rates, as we were seeing at the time, particularly as the world was awash in liquidity. You add that to a booming economy in much of the 1990s, you had the recipe for a pretty hot housing market, which continued. But over time, as asset classes tend to get, it got overheated. And all of a sudden, in the beginning of this decade, it was normal to see home price appreciation in many markets, particularly the two coasts, annualized at a double-digit pace, far exceeding income, far exceeding the growth of income, which if you step back for a second, doesn't really make any sense, because you should only be able to borrow what you can afford to pay, so somehow that should put a governor on what prices did. But it didn't happen over time. By 2005, we had reached a situation with that rate of home price appreciation that more and more investors were drawn to the market. It was estimated that at one point in 2005, somewhere between 25 and 30% of all the home sales were purchased by investors. For people who own their homes, particularly low-income families, but for all families, people were interested in taking advantage of this equity buildup. They wanted to liquefy the equity, the worth of their home. And they ended up going through refinancing and home equity loans. Indeed, one of the phrases I recall from that period were serial refinancers. Rate went down 25 basis points, I'll refinance. Wait another month, goes down another 25 basis points, I'll refinance again. What used to be a goal of people like my parents, which is someday we'll have no mortgage, all of a sudden was put in the back. And the notion was, how do I capture, how do I take this equity? And then lastly, the issue of affordability. The prices went up so high that there was no way that people could take out, quote, regular loans or prime loans to afford the prices. Enter the world of subprime lending. And it's hard to overstate the dramatic sort of buildup in subprime lending over this period of time. It represented a minimal share of home mortgages in the 1990s. Matter of fact, as recently as 2001, represented only 2% of all home purchase originations. In 2005, it represented 20%. Everybody was in the market of extending credit. The whole system promoted, rewarded selling of mortgages. Mortgage brokers now originated over 2/3 of the mortgages, as opposed to the 1/3 they did 10 years earlier. And they were paid on commission. They were paid on the basis of the loan being originated and had no interest in whether or not it was repaid. Mortgage banks needed to get to scale. And getting scale, they essentially sort of bundle these mortgages and work with investment banks, non-regulated financial institutions, to put them into these complex securities. For the early part, for that 2004-2005, even though these subprime loans started to emerge, it really wasn't a particular problem because of the lag effect. Because people who couldn't pay off these mortgages with these toxic terms, with these exploding payment cycles, not to worry. If I can't pay my mortgage, I'll put a for sale sign on the lawn, I'll sell it, I'll walk away. Well, as finally that housing bubble burst, those exit doors were closed. And all of a sudden, we started to see record numbers of delinquencies, record numbers of defaults, and record numbers of foreclosures. And then the question was, well, who bore that risk? Who bore the price? That's when it got particularly interesting. Because what had happened with these subprime loans is they were broken apart, taken apart, put in little subsets, and put in a whole variety of different sort of securities. And no one knew what they had. At that point, government had stepped aside, had genuflected at the altar of the market as it relates to our housing finance system, and the de facto regulator became the credit rating agencies. In a sense, I think if I had more time, I could make an argument that in the middle of this decade, we essentially outsourced and privatized regulation. And as we've learned, the credit rating agencies weren't able to do the job. Whether it was the complexity, whether it was their eagerness to take part in the system, they couldn't do the job. Where are we today? Well, today we're at a bad place. As a result of the housing market appreciation, the builders, of course, responding to that appreciation, overbuilt. We estimate at our center we probably have 1 million more homes that we need now. At the precise time we need credit for people to buy those homes is the time credit is constrained. Subprime lending has essentially withered away. There is no more subprime lending. And in some eerie way, it looks like we are going back to the future. If you want to buy a home today, you better have great credit. If you want to buy a home today, you better have a down payment. And that all sounds fine, and that all sounds secure, but it certainly leaves behind sort of millions of families who are at the low end of the wage scale, who have some impairment in credit. So it is a story that we know what happened, we know how we got there. The challenge before, in the short term, to use Jay's analogy of taking care of the immediate patient, our short-term strategy has been to nationalize the housing market. But even in nationalizing the housing market, is that a good strategy over time? And if you nationalize that market, how do you balance? How do you balance between extending credit and making sure you have safety and soundness? That's the question.
Thank you, Nick. That's terrific.